Hello and good evening, everybody, ladies and gentlemen. Today with me here is a person who has spent 30 years in the financial industry. He is a man that managed a lot of millions of dollars as a capacity of a former CFO. But more importantly, this guy, he is able to teach you how to master your personal finance, to be able to optimize your cash flow, to be able to help you manage it in using more than one strategy, something like gearing up. Today, he will be going to share in depth about what's going to happen when we gear up a property, how the mechanics work, and everything. And with that being said, I would like to introduce the silver fox of Unbeatable, Mr. Kyung Sham.
Hi everyone, my name is Kyung Sham and I'm with Unbeatable Mortgage, and thank you so much Ethan for such a wonderful introduction. So tonight we're going to talk about gear up. Now we're going to gear up for something really exciting, and we're going to gear up for our next investment opportunities. So without further ado, let me start with talking about what gearing is all about. If you're a finance guy, you know what that is, debt to equity ratio. If you are not, let me give you a theoretical explanation what gearing is. Gearing is really about the relationship or the ratio of debt to equity. And that is how much debt do you have versus the equity that you have, which means the financial resources that you already have. So today we're going to talk about at what level of debt are we comfortable with to get into a position where we can make further investments. This gentleman here called Mark Tilbury, in his handle in the TikTok is called Millionaire at Mark Hilberry. So let me show you this video.
Maybe you can describe to us what this video is about.
You and I just talk about it, okay? If you look at what, let's look at the captions. Why do you need to borrow money? He said, we don't need to. We choose to get into debt. But I was always told that debt is bad. But that's the power of leverage. What's leverage? Well, you could use all the money to buy property, all right? And then I'll let you read it. Because he's talking too fast, I couldn't read in time.
Yeah, makes sense. So the thing is, he is using debt to be able to leverage in terms of the property journey.
Correct.
But more importantly, debt gets you the affordability to be able to buy the property. Because a lot of times when people choose between rent or buying a property and paying for mortgage, they always choose mortgage. Because you can't really pay for your rent with CPF, and mortgage is the way to go lah.
Yeah, correct. Exactly. So that's the essence of this video. He's basically saying that, you don't need to use your own money. Use somebody else's money to make all your investments. Okay. Before I go on to that, let me talk a little bit about who we are as Unbeatable Mortgage. Okay. And we are a mortgage consulting firm. We specialize in bank mortgages throughout Singapore. We have a stable of 10 banks, 3 local banks, UOB, DBS, and OCBC, and 7 other foreign banks: Citibank, Hong Kong Bank, Maybank, Standard Chartered Bank, CIMB, RHB, and Hong Leong Finance. So we have these banks in our stable that will be supporting the bank mortgage consulting business that we do in Singapore. And as a company, Unbeatable Mortgage is a Singapore accredited mortgage planner. We are certified SAMP. In our most recent review, Google review, we score a 4.9 stars out of, and that's 127 reviews that was done. Out of 568 optimized profiles, there are 27 YouTube videos that we did, and there are a total of 127 reviews that's already done so far. In essence, we sell cash. All right, providing a mortgage loan means we are selling you cash. But why do I say I sell you cash? Because what you get is cash to go buy a property, right? And this experience is a carefree mortgage experience that we provide to you so that you get the cash to go buy your property. And what do we do in terms of helping you? We help you save interest expense along the way. We help you save not only interest expense, but all other penalty expenses that are in your contract with the banks as the term of loan expires. Example will be your clawbacks of expenses such as legal subsidies. We will help you manage that as well. The second part is really to help you manage your TDSR exposure. You know, TDSR stands for total debt servicing ratio, and it really measures how much debt you have out there in your personal capacity vis-a-vis the income that you have. And banks look at it as at a particular ratio and at 55%, which means MAS has mandated that you can spend no more than 55% of your monthly income on debt. And by debt, we mean not only mortgage loans, it includes car loans, personal loans, secured loans, unsecured loans, credit card expenses, because credit card expenses are loans. So the total of this cannot be more than 55%, and we help you manage the exposure.
Absolutely. And I just want to add on, right? Like, this is very important, especially when you're looking at optimizing your profile. The way you actually phrase yourself into towards the bank, right, is very important because it can be the difference of one loan approval and a substantially higher one. So yeah,
Correct.
wonderful, wonderful point.
Yeah. The third thing we help you is to help you repair your credit rating. You know, as you make a loan application with the banks will invariably refer back to the Credit Bureau of Singapore for your rating. Now, if your rating had been perfect, if you have a perfect score, then obviously the bank will lend you the money. You know, the irony of lending money is that they will lend you money when you don't need money. They won't lend you money when you need the money, right?
Absolutely
So
right.
so we and when you are in a situation where you needed the money and the bank won't lend you the money, we will help you manage and repair your credit rating. This will be a totally different topic altogether, and we'll do it in the next podcast. But this is one of the services we provide for our customers. But that's that on who we are as Unbeatable Mortgage. Right now, for tonight, for this podcast, we're going to talk gear up. So the whole session for tonight will be on gearing up. Okay, I'm going to show you another video, and if you look at this gentleman here, I assume you know who this gentleman is. He's Robert Kiyosaki, Rich Dad Poor Dad, right? So there is a video here that he talks about debt. So Get Rich with Dad, that was his video, right?
When you borrow money and are able to make it work harder for you, right? Then the interest rate, right? You are actually making money work for you while you're sleeping. So one thing I really like is the concept of a good debt, Sham. Sham. So one thing I like to touch on now when we are talking about what is a good debt, what is a bad debt, all right? So a good debt, right, I feel is a cheap debt lah. Bad debt is one that is very expensive. And Robert Kiyosaki also says that when you are borrowing money, let it go into other investments. Am I right?
Correct. Correct. So it's about using somebody else's money, in this case, the bank, to earn money. That's a good
Correct.
debt. So good debt is a powerful tool in that sense. But it is a bad debt, and debt is bad when you didn't use it to make money. You use it to buy liabilities. And there are some of the liabilities he mentioned. You buy luxury items. You buy cars. Cars are depreciating assets. So why spend money on cars? And that was his point. Why borrow money to buy a car? Because the borrowing money to buy a car is just an expense. It will never make you money. He mentioned about houses. The different. I think he was trying to refer to people who, in the U.S., when they borrow money to buy a house, they were not able to repay the debt, and they are always in that debt cycle.
Yeah.
Whereas in his case, he's buying properties. He's buying investment properties.
Mm.
If you think about people like Donald Trump, when he first bought that hotel in 1970s around the corner of Fifth Avenue and whatever street that was, when he bought that hotel, he negotiated with the bank and said that particular place is an asset, and he said if you lend me the X millions of dollars, I will generate 10 times more revenue back for you. and the bank lent him the money. So in buying the property, Donald Trump, when he bought the hotel, he bought it with the intention to make money, and that's why for him, he for him that is good. All right. And if you also notice in 2016, when Donald Trump was debating with Hillary Clinton about taxes, he said, Hillary Clinton said, Donald Trump doesn't pay taxes. And Donald Trump basically said, yes, I don't pay taxes. And you heard what Robert Kiyosaki said too. I don't pay taxes. And the reason why they were able to not pay taxes is because they said, I follow your tax code. Your tax code allows me certain tax reliefs. So in the Singapore context, there are certain tax reliefs for us. For example, we have no capital gains tax. We need to take advantage of this situation where there's no capital gains tax, and if you make investments in properties and there are capital gains, then you are
You
actually getting yourself into a situation where you make an investment and you don't have to pay tax. So things like this are very powerful messages from Robert Kiyosaki about using the debt as a powerful tool and in buying assets rather than liabilities.
absolutely. And Sham, like for example, right now interest rates are about 2.5% for their fix. So if you are looking at a long-term inflation of 2%, you are looking at the real interest rate of 0.5%. This
Correct.
this is spectacular, especially when you're about to talk about gearing up. Gearing up is the optimization of debt. And I will let you go ahead.
I'm going to show you one more video before I move into the topic of gearing up. Yeah, utilizing leverage in real estate investing. So now he's talking about how you leverage for real estate investing. Yeah, what he talked about was basically use other people's money to buy the property and make money off it. That's the essential message.
Absolutely.
Utilizing leverage. When you leverage something, it means you are making use of somebody else's money to invest in real estate, and that is the bank. Who's the somebody? It's the bank. That's why we are in this business of Unbeatable Mortgage. We are here to help you leverage into real estate investing. So here's an example, and this example is to accentuate what the gentleman has spoken about leveraging the debt from the bank. So let's say, recently there are some launches called Nava something property in Ulu Pandan, Colin Road. I think the smallest unit is about $1 million. And let's say you're interested in that. You're interested in investing in that property, and you want to buy that property because first of all, it's a new launch. When there's a new launch, when if you walk in the first day of the new launch, invariably the property developer will give you a discount. And let's say if nothing happens, and if you want to flip the property, if nothing happens to the price, you still make money on the discount. Let's say that's your strategy. And you went in there, you want to buy this property with the intention to be able to make money off it in 3 years. Why 3 years? Because when you buy a private property, you are only allowed to sell it after 3 years later. And let's assume TOP takes 3 years. So by the time from the launch to TOP, it will be exactly 3 years. And when it TOP, you are now in a position to sell that particular property. Okay. So let's say this is what your intention is. Go ahead, Ethan.
Okay, so I want to add something. You are able to sell away your property from day one, actually. But on the first year, if you want to sell away the property, the seller stamp duty is 12%. Second year, 8%. Following year, 4%. However, in Unbeatable, right, we are big fans of holding on to the property. So if it happens to be a property that you want to stay in, and your thesis, right, is to hold on to it and rent out or whatsoever, you can actually buy in early, so that, like what Sham says, the developer gives you a discount. But make sure you go in early. Don't be the ones that are behind pushing up the price. Try to be the earlier portion lah. So what happens is, when you are doing that, you're actually able to buy a $1 million property with how much, Sham?
With very little money. In this case, in Singapore's example, we are talking about 30% down. Why 30% down? Because the whole structure of a loan in Singapore for buying private property is about 25%, plus stamp duty and legal fees and so on and so forth. Let's round it up to 30%. It should be about 29-ish, but let's say it's 30%. So you need to have at least $300,000 cash in hand to be able to buy about $1 million property and leverage on the bank for the remaining 700,000. Okay, let's say you do that. You have 300,000 cash, free cash somewhere, and I'm going to talk about what will happen if you don't have the free cash somewhere. What you can do, and we'll talk about that as well. But let's say for the purpose of the example right now, let's say you have 300,000 free cash immediately. You go ahead and borrow 700,000. Okay. And let's say if the property value appreciates to 1.1 million after 3 years, all right, and this is, I'm making the assumption that when it TOP, you want to sell, okay, and you can gain, therefore you gain 100,000 profit. Let's say, example, yeah, the property value is appreciated 3 years after 3 years to 1.1 million. That means that you immediately in the third year you made 33% gains on the initial 300,000 investment, right? 100,000 divided by 300,000, that's 1/3. So 33%, you made 33% profit. And and if you divide that by three years, that's roughly about 10% per year per annum. So having a return of 10% per annum, I think it's not a bad return for an investment of 300,000. So as an investment tool, this is investing in properties gives you this ability to make huge gains. I call it huge. 10% to me is a huge gain because it's better than putting a fixed deposit, right? To make huge gains with the free cash that you have. So this example is if you have the free cash, okay? The question is, if you do not have the 300,000, how do you get the 300,000? Where are you going to get the 300,000 from?
Can I interject?
Sorry?
Can I interject?
Sure.
Okay.
Go ahead.
So actually, right, if you're looking at this, right, you are looking at having not a lot down. This is our normal calculator, and what we do, right, is to be able to tell you how much you are actually needing to be able to buy a $1 million house. If you have enough CPF, $242,000 worth of CPF, the amount of cash you need is actually only $50,000. Apologies. This tells you how much is the loan. You have to calculate the property tax. We actually do the calculations for your monthly installment, including understanding how much CPF comes in from your basic pay. So that's it, right, Sham? If you're looking at using cash on cash, but you have to actually account for CPF ordinary account, yeah?
Correct. You are right. I missed the point. My apologies. I should have stated that it's cash plus CPF, 300,000.
Absolutely. So the thing is, when you're looking at this, right, less than $300,000, you're able to own a house. And when you're owning a house, right, let's just say this is a $1 million property, 2 bedroom or something like that. Your alternative is rent, and rental is approximately $3,800. So you're looking at something like this, 3,000, 3,005, 3,008, somewhere around there. As compared to the monthly installment that you're paying $3,000 per month. Out of that, 1.5K can be used in your CPF ordinary account. The cash flow you actually need to bleed is only 1.4K, which is a lot cheaper than paying for rent in any place in Singapore. What do you feel, Sham?
I totally agree with you. That is so good, cool. It is one of the easiest way to own property in Singapore by just sheer example of that calculation that you just explained. So I think if the audience who can follow your articulation just now, it makes a lot of sense. It makes a lot of sense to do exactly as what you just described.
Absolutely. And yourself, you've gotten rich by paying for your mortgage. And at this point in time, you're towards your retirement and enjoying your golden years. So
Correct.
you are somebody that has been there, done that, paid for your mortgages, pay your due, done your whole life, did your 3 kids, everything. and now you're here to make our life more interesting. So
Right.
please share with us a little bit more about our gearing up.
Right. So now let's say I'm going to paint a picture where you do not have sufficient CPF and you
Mm,
need the cash.
mm,
All right. Let's say you don't have sufficient CPF. There's the example that Eden talked about just now was you have CPF
mm,
and therefore you use very little cash.
mm,
Let's assume that your CPF on your current house has already been exhausted,
mm,
and because you are living in your own current house right now, and you have already utilized your CPF, and you have very little CPF to contribute, and in that instance you need more cash, and in this case the question is how do you gear up to get that cash, right? The theory behind it is about intrinsic value. Now, this what is intrinsic value? Intrinsic value is a hidden value. If you're in the stock market, you will understand that between for a company to have its valuation go up to a certain value, there are real value and there's intrinsic value, and the intrinsic value is the hidden value. There's a financial formula for that, and you can see up there. Tonight is not the night for us to go into the theoretical calculation of intrinsic value, but there is a way to calculate that. But and for properties, there are intrinsic value that are embedded in each of our homes that we own. So let me talk a little bit about that more. Now, if you look at this picture here, intrinsic value actually builds up over time. What do I mean by that? When you first purchase a home, let's say X number of years ago, you purchase it at a particular price. And based on today's valuation, the house has a certain value, and that value has multiple times of increase in value over the price that you purchase. That built up is what we call a hidden value. Why is it hidden? It's hidden because you have not realized it yet. The house is worth that value. You have an asset that's worth that value, but you have not monetized it. So in Singapore, we talk about this phrase, asset rich, cash poor. When you have intrinsic value built up like this, you are asset rich, but you are cash poor because you have not monetized it. And the question is, how do you monetize this intrinsic value so that you can take out the cash and make use of the cash for other investments to make money? So my mother used to say, use money to make money. And basically, now we are going to talk about how to make use of this intrinsic value and unlock it, turn it into cash, and use money to make money. When we gear up, banks allow to take that intrinsic value and say and extract it out and say, okay, here's how much you can take out. And how do you monetize it? The bank will give you 75% of its valuation, less the outstanding loan, less the CPF that's already used to pay for the existing loan. And whatever is the remaining value, that's the value that the bank can theoretically afford to give you as cash for you to monetize. Okay.
Okay, excuse me, I got a thing to share. Okay,
Okay.
so the thing is, valuation, right, is a very interesting valuation is a very interesting endeavor, lah. I would like to say. What we can actually do, right, is actually look at how value can be actually seen from all the past transactions that has been happening. So I would like to share with you a little bit about what I do to help my clients understand their valuation, understand what's going on, lah. So as an example, right, I'm gonna use 5A Shenton Way, which is a place that I used to live in. So we are able to see where the valuation actually is. Okay, at this point of time, based on current trends, they are saying about 1.4 mil there about. So what you want to do is then go into the property, understand when it is built, how many units there are, and then look at when was the property sold. We also have tools that are able to go in to the point that I am able to see which property was bought at how much. Let me show you. For example, we are looking at 1522, right? At 1522, you are looking over here, you can see that the person actually bought on 2nd October 2012. So actually all these numbers and all these data do help with our valuation. But let me tell you guys what is our superpower when it comes to valuation. All right. So as you guys know, right, we got 10 banks. Okay. So we have 10 banks. Let me come up and let me get a screenshot. One moment. So you guys know that we have 10 banks. So what happens with these 10 banks over here? What will happen is that we will then talk to all of these banks. Okay. So imagine we are the people that you talk to. You talk to one person, not 10 people. So you talk to us and we will talk to all these 10 banks for you. Each one of the bank will have a couple of valuers. All right. They might have 10, they may have 20. All I need is two people to say, yes, I am able to match that value for you. And because of that, right, even in a circumstance where your valuation, right, may be lesser than ideal. For example, this property, if you want to gear up, maybe you may need $1.5 million. And over 10 banks, I am pretty sure that there is one person that is willing to match the $1.5 million or even higher. The beautiful thing is that we have 10 banks and we have 100 valuers. So this is how we can actually put you on top with just gearing up higher.
Great. That's a very good point, Ethan. Yes, actually, today I sent out a message to some of the banks to get valuation. I noticed that each bank came back with two or three numbers. So in my mind, each bank they have already had feelers out to two or three valuers, and because I reached out to three banks, so I got nine valuation numbers given to me, and that range can be very low, and then it goes up to slightly higher than the other guys. So
Yeah,
that helps, and that's a very wonderful point because it does point to our ability to source banks that will be able to help you meet your requirements, and that's a very good point. Thanks, Ethan.
no
So
problem.
I'm going to move on to the example, yeah, of what I've just said about 75%. Let's say, okay, and this is a real life example of one of my clients. The current home was purchased at 1.4 million in 1999. It's a private home, a landed home. All right, it was purchased at 1.4 million in 1999.
It's
Uh,
familiar.
it's familiar to you, right? You know who the client is, right? Yeah, good. Yeah. The value of the home now is about 4 million, right, in 2024. The intrinsic value, therefore, is about 4 million minus 1.4. There's an intrinsic value of 2.6 million. This is cash hidden in the house, 2.6 million, that is locked in and cannot and not monetized, right? If I had this $2.6 million cash in my hands, there are so much things I can do with that money. I can go make some investments in stock market. I can make investments in other properties. I can make investments in businesses and whatever the situation may be. Yeah. So, but this intrinsic value currently is locked in, and there is nothing I can do or my client could do until it is unlocked. All right. Let's see how to unlock this 2.6 million. 75% of 4 million is roughly about 3 million. Well, it's exactly 3 million, not roughly. Let's say 3 million. There is an outstanding loan of 600,000. So in the 20 years, the loan was paid down to only 600,000 now. Okay. The CPF that's already utilized is actually 1 million, but there is a 400,000 interest to be paid on that 1 million CPF loan that was taken. This is the ironic part of CPF. CPF is your own money, and they allow you to take your CPF to pay your monthly installment. But they said that if you ever sell the house, all right, you got to pay back the money you took from CPF. But it's your money, right? So it's kind of ironic. But that's the rule. So let's say we follow the rule, and in this case, the client has only taken 1 million out of his CPF account. All right, from in the 20 years paying through CPF. and CPF levied 400,000 interest on that 1 million. That's a lot of money, that a lot of interest that CPF charged the client, right? So you got to, when you sell the house, you got to pay back 1.4. But if you are at my age, 63, right, this has a relatively less meaning, because if you pay back the 1.4 million to CPF, immediately I can take it out. So basically, it has no real obstacle for someone who is above 55 years old.
And have FRS, full retirement sum. You need to have that.
Oh yeah, you need to have full retirement, of course, right? But for a person who's less than 55 years old, then if you ever sell the house, you got to pay back this 1.4 million, and then it sits in there. But sitting in there means you can still withdraw it for the new purchase. Okay, so which is why just now Ethan talked about cash plus CPF. So this CPF already utilized has actually very little relevance in terms of its ability to be blocked for usage, because you can use it whether you're 55 and above or 55 and below, because you can still withdraw it for the purchase of new property. Okay. Now,
Absolutely.
in this case, this client of mine, he's got a 3 million there, right? There's a haircut of 25 million, 25%, so there's a 3 million available, minus 0.6, minus 1.4. Available intrinsic value is 1 million. So technically, this client can go to the bank and say, "Hey, I want $1 million. Can you give me $1 million?" Can you imagine if you have $1 million in hand? What can you do with the 1 million to make that 1 million grow into two, from 2 into 4, 4 into 8, and 8 into 16, right? So
Absolutely.
gearing up gives you this possibility. It opens up this opportunity for you. It opens up this horizon for you. It opens up this possibility for you to do things that you would otherwise not be able to do because you have shortage of funds. That means that you are now leveraging. You have just approached the bank and say, "Lend me that 1 million." Who is this? Who is this fella? This is somebody else's money, right? The bank's money. You take 1 million from the bank and you take the money, it's somebody else's money, and you go make your investments. So it's really interesting concept here for you to be able to say, "Hey, an asset that has a value and I want to unlock it. And once I unlock it, I can make use of it. I use somebody else's money to make money." And that's the whole gist of what gearing up is all about.
Absolutely. But can I elaborate a little bit further from this? Because there is a way that you can actually take out 2.4 million.
Uh-huh.
All right. The CPF is one of the best investments, the best products that Singapore come out with to be able to stabilize the housing market. I just want to say I'm a big fan of their work. So that's it. We love to follow rules. So let's look at two rules. Okay. So over here, right, this is your slide. So let's just say, right, the current amount of CPF utilized is 1.4 mil. So if we are able to take out this, we are able to get 1.4 mil loan more. Yes?
Yes.
So we are going to do this by following a couple of rules. Rule number one is that when you're not selling your house, you can actually make voluntary housing contributions into your ordinary account. The next thing that you can do over here, right, is other than making voluntary housing contribution, then money goes into your ordinary account, correct?
Correct.
So assuming the same thing, you owe them $1.4 million excess, but inside your pocket, right, you have $500,000. So what you do a voluntary housing contribution right now. You do a voluntary housing contribution, you put $500,000 into your CPF ordinary account. Following?
Yes. So the balance is now 900,000 in CPF
900K.
that you're owing.
Okay, so the amount you owe to CPF is 900,000, but inside your ordinary account you have $500,000, and your full retirement sum has already been met. Over here, you are above 55 years old. You want to make a withdrawal. You can actually make a withdrawal above the full retirement sum. If you have met the full retirement sum, you can withdraw any amount of money in the ordinary account and special account. into your retirement years. So what this means is that when you come over here, this 1.4 mil, it will go to 900k first, correct?
Correct.
And then after that, you're gonna take the 500k inside your CPF ordinary account out into cash.
Correct.
Then when you have 500k cash, can you do another CPF voluntary housing
Absolutely.
refund? Yeah, hell,
Absolutely.
we can do that. So we do the voluntary housing refund again, and then lower the 900. Now it is $400,000.
Right.
$400,000, and then one last time for the road to make it zero. And then when that happens, the amount of loan you can take is 1.4
2.4.
million plus $1 million. So together, the amount of loan you can take is $2.4 million. Assume that the interest rate you can get is 5%. Okay,
Yeah.
5%, something conservative. We don't go into option strategy and whatsoever. We say 5% per annum as compared to the 2.5% that you are paying. Okay. Once again, investment comes with a lot of risk. Use your brain, not our problem. We are not God. We are hardworking. So that's it. We say we take $2.4 million, 2400000 multiplied by 2.5%. That is $60,000 extra for just using your brain.
Yeah.
Worth it
So
or not, Chum?
absolutely. What most people like to use call what uh,
Rinse and repeat.
rinse and repeat. Yes. All right. You rinse and repeat with the 500,000 cash that you have. Putting the 500,000 cash, reduce your loan, but actually the cash you can withdraw it immediately and then you put it back in again and you rinse and repeat. So it's a very interesting way of taking out money without putting in money.
Absolutely. I don't know how long this is gonna be up. The
Yeah.
problem with sharing all of this information online is that people like MES and CPF may look at all of this and then decide adios. So
Yeah.
that's it. More importantly, guys, we have a lot of strategies. If you guys like that strategy, we got a lot more that we will not be able to share today because we are in public domain. Sharing things financially in a public domain is worse than having a colonoscopy from MAS. So at this point in time, please, guys, sign up for our consultation form so that we can talk in private, so that we can understand your situation a lot better. I understand a lot of people just come to me for cheap rates, but honestly, the amount of savings we get for catching all the different things that they may cock up on is insane. That's why everybody, I urge you to go into the sign up link at the bottom. You should be able to see in the description below. Either Sham, me, or another one of our teammates will be able to be in touch with you. So please get in touch so that you will be able to have all of the mistakes caught, all of the savings taken, and you can have a very, very boring route to become a millionaire. That's it.
Good.
Sham, still got anything else to share?
I wanted to end by talking about why mortgages, yeah? Because
Love it.
mortgages
Go.
are cheap. It's a cheap form of access to funds from somebody else. So you're really using somebody else's money to do what you need to do to earn money, and it's cheap because long-term debt is secured by your property, and there is no immediate pressure on you to go settle the debt immediately because it's a long-term debt. Your tenure is for 20 years, 30 years. So it's easy for you to manage that cash flow in that sense.
Beautiful.
Secondly, inflation does not happen when you don't own the money. Think about it. If you had purchased at home, like my client did, 1.4 million, and you borrowed whatever the amount of money that you had borrowed then, over the 20 years from 1999 until 2024, whatever you're owing the bank remains the same amount. It doesn't change. It doesn't change with inflation. Your contract, your loan contract with the bank doesn't change. So inflation doesn't affect your debt at all. The real effect on your cash is almost zero after accounting for inflation as a result. Okay. Now I'm going to end this podcast with this video. by Mark Tilbury again. It's about the rich versus the poor. It's a philosophy. He's going to talk about a little philosophy here, and I want to share this philosophy with you. The rich will invest the money, a lot of their money, and spend a lot less. So while the poor will spend a lot more and invest less. So it's a mindset about where you want your investment philosophy lies. Yeah, if you're taking on the philosophy of investing, then you will end up having a different mindset compared to the one who has decided to spend more than investing. So I leave you with this thought that what the rich people do versus what the poor people do, and maybe and you can pick it from there on how you want to move on with your next investment journey.
Absolutely. And I couldn't have said it better myself. You are the person that I remember from that one TikTok video. That one TikTok video, you said that there are 6 words in finance. What are your 2 favorite ones?
Cash flow.
Fuck yeah. With that being said, good night, everybody. It was fun. I'll catch you guys again soon. Adios.
Bye bye.